Okay, 3, 2, 1, let's jam. Hello and welcome, everyone. I'm Corey Hoffstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hoffstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
Today, I'm talking with Thao Tran, co-founding partner at Vamient Capital. This episode was born from a question I had watching the NFT marketplace. How do you make markets in illiquid, non-fungible assets? Clearly, people were doing it, and I wanted to know how it differed from traditional market making. Several people recommended I speak with Thao, and she was kind enough to oblige, despite NFT market making being just a small component of what she does. In this conversation, she walks me through how the NFT marketplace has evolved, how she thinks about managing inventory risk, key features that impact spreads, and how platform evolutions changed order book strategies. In the back half of the conversation, Thao shares her thoughts on the state of the crypto markets today, the emerging opportunities in decentralized exchanges, and how the landscape of alpha opportunities has changed over the last several years. I hope you enjoy my conversation with Thao Tran. Thao, welcome to the show. Excited to have you here. This is going to be a really unique episode. This is one that I've had on my mind looking for a guest for a while, and your name came up a couple times. People suggested I talk to you. So thank you for taking the time. Really excited to have you here. Really excited to dive into this topic.
Absolutely, my pleasure. I've been a fan of the show for a while. I didn't even once think that I would be here, let alone discussing this niche topic that we're going to discuss. So pleasure's mine.
Well, let's dive in. So let's start with your background, because we're going to be talking about cryptocurrency markets. That's not where your career got its start. You actually started at JP Morgan Fixed Income. Can you talk a little bit about how you got started in markets and how you decided to make the switch from traditional finance into cryptocurrency?
I got started in markets straight out of school. So when I left school, I first started with an internship at a fixed income desk, but like an emerging markets desk. And then when I started full time, I moved on to the treasury and the stud desk, and then more specifically focusing on Japan and whatever Japan desk is trading. That was my background. I was there up until 2017 or 2018, pretty much just focusing on the same FICC products, and then do a little bit of stud here and there and focusing on treasuries. And then during COVID time, it was a close friend of mine who asked me to look into running basis trading strategies from home machine, because JP Morgan doesn't have any compliance and issue with us trading. They publicly do not recognize this as a financial instrument up until recently. For people on markets like us, we cannot trade pretty much everything except for cryptocurrency. So I started to take a look deeper, and then got hooked into the different DeFi thing that was hot at the moment. And then in 2020, NFT became a thing again. And then I remember I used to dabble in like CryptoKitties back in 2017 or something like that. So that kind of piqued my interest, and I relook at the whole scene once again.
The initial premise for this episode, at least, is this idea of talking about making markets in illiquid markets. And NFTs are certainly an interesting, unique market. This is a space that's been through quite an evolution in a short period of time, both in volume and venues and what's being offered, types of NFTs. I was hoping maybe you could talk a little bit about how the space has changed from the earliest days of things like CryptoKitties in 2017 through today.
Absolutely. I think this was a discussion. I didn't create the first ever NFT like CryptoPunk. I didn't mint them. I didn't own any of them out of mint. I did buy them at some specific point. just for profit and no cultural aspect. My first ever experience with NFT was actually CryptoKitties. I grew up with Neopets, so when CryptoKitties came about, and then the whole idea of owning your own thing on chain is forever yours and this kind of thing, this was instant hook for me. When I first got started with the CryptoKitties, there was already concepts with Genesis generation. This would be things like Gen 0, Gen 1, Gen 2, and then the whole idea of breeding already came to space, and then the idea of trades and like the rarity of these trades already plays into the pricing of your kitties. And then there's already some concept of like bidding and accepting the bid and this kind of thing. So there was like a very premature marketplace. I couldn't remember if it was any specific thing, but I think it was like native CryptoKitties marketplace. So it's only trade CryptoKitties, and then you can even trade the unhatched, the eggs or whatever it was back then. It was that. And then when you scroll, it was like scrolling through the thing, and it wasn't even lazy loading. So you can just load up everything, and then it was just arranged chronologically by price and this kind of thing. So you can straight away filter by the metadata of which one you want, and then what's the cheapest. The simplest thing I did back then was I want this specific trade. What's the cheapest that was available? And then you can clearly see the mispricing for like a few of the specific trade that you have. So I think that was fun. It wasn't much of a volume wasn't there. You can wait hours and hours and nobody cares about the higher than normal bid that you already put. Nobody seemed to care so much about pricing. They just seem to want to like collect the whole collection. So then you have to wait until you already have a few of the trades that you have, and then you go bid for them again. And then after that, I think the whole revolution of like OpenSea and eventually OpenSea evolved into OpenSea Pro by acquiring Gem, and then Plur came into place. It shifted the whole level of the NFT trading. OpenSea, they already have things like people want to be first, so they have like different ways that time that you can ping the server somehow, and then you can get the decoded metadata. And before it was even came out of the mempool, it's listed officially on the OpenSea front end. You can already bid and then buy that instantly, and then relist it within the second block. That came with a lot of technological advantage for people who understand blockchain. They would pay outrageous gas and they would try to buy in a bundles and then release and this kind of thing. And when you see like a bid coming in for a trade, and then you try to snipe another one with that trade and then try to quote that at a bid that people are willing to pay for. So this kind of thing happens. It still happens, but much rarely nowadays. That alone, the OpenSea alone already makes like the volume pretty much 100-fold from the time that it was just a native marketplace of fragmented NFT collection. And then Plur came into place, and then you have people bidding for everything, like even things that are purely watching the collection volume and blue chip collection. You will see people outbidding each other, not in the same way, but you can see similarity between like a normal open book liquid asset when people try to penny each other to be top of the book. And then on the order book, you will see algos that just try to follow one specific lash holder of the collection. So whatever that lash holder of the collection put a bid at, they will try to penny up a bit. This kind of thing happen, and then people come up with different tactics, and then there's also a lot of predatory things that make the same logic with like a fat finger in traditional finance occur in NFT, and you will see a different crypto Twitter thread about like, oh, this person accidentally sold it for one fraction of the actual price, and then you will see things like, oh, somebody paid a fortune for something that costs nothing. This has made the NFT such a vibrant marketplace that it is right now. It's still not at the same level of liquid asset. I would argue that it's to a certain extent it's more liquid than real estate and this kind of thing.
Can you talk to me a little bit about when you decided to jump in and make markets on NFTs as a serious endeavor in that time span. We started with the earliest days of crypto kitties, where you're talking about a single market, not a lot of activity, very inefficiently priced, all the way up to very active markets across. Probably Blur is the most highest volume venue today, but where you have very sophisticated players, a lot of interesting order book activity going on. Talk to me about where in that time period you got involved and what made you get involved at that time.
I got involved around the time of OpenSea, the first version, not the improved one. That time there was already Gem, but it hasn't been acquired by OpenSea yet. I think I got into this just because there was some collection that I managed to snipe at a very good price. So I have inventory and I want to get them out at a pretty decent price. I don't have any rush. I just want to make sure that once my initial cost of the inventory is already out, the rest of my inventory I want to sell at a price that's worth it. So that was when I first got into it, just because I have inventory. Eventually, with the one collection that I have inventory, I saw that very few people will sell it at the floor price. The floor price is like listing price in real estate. People will negotiate around that price, and there will be different parties who want to aggressively bid and then who just want to wait out and stuff. Because of that, then I start to also make on the bidding side. At first, I was only trying to sell on the ask side. So that was first. And then I first thought that that collection wouldn't be there to stay, but actually it became one of the blue chip collections. So when NFT got hit up and there was more and more hype into the things, and there was a lot of collection that I didn't manage to snipe the quantity that I want. So I actually want to get in and get out of the collection. Even with little inventory, I start to go and make market on both sides.
You've used the phrase snipe now a couple of times, and I'm not sure all my listeners would necessarily be familiar with the NFT minting mechanism and what sniping is. Can you just really quickly explain what that means?
For collections, just when you IPO, so there would be initial offerings, you would be trying to mint. So for minting, there's a lot of ways that people can mint. People can get a whitelist and then they guarantee some allocations into the initial offerings. But most of the time for normal participants, I think once the public route is open, people will just try to make sure their transaction, their intent to bid lands in the mempool and then get committed onto the blockchain. And then that is referred to as sniping because you have to pay for gas. Gas meaning that the higher you pay for it, the more guarantee and the faster your transaction will be confirmed on chain. You can get your shares of the NFT you want to buy.
Can you talk a little bit about, at a high level, what your thesis was here? What edge did you see yourself as having? Why ultimately spend your time here versus the multitude of other types of trades you could be implementing?
I first got here because I have edge in making sure that my transaction got landed first on the blockchain. So that was my first advantage. Later, when this no longer hold true, people have better mechanism to make sure their transaction got there first. They have a dedicated RPC or they pay an obscene amount of gas that I don't think I can factor in for the basis cost of the NFT. Eventually, it became like, oh, okay, given the order book, given the market is like this, what's my strategy to get the best fill rate? It became like an interesting problem because I think my competitor or counterparty at the time who were doing this were very few. I can name only three of them. And I got into close relationship, really good friends with another. And then that's pretty much all that we do. And even within ourselves, we have different edge. I will highly go for like the hype project at the time. So there will be a lot of volume and then you need to make sure that you don't go against the momentum and the trend. So that was the collections that I focused on. I know a few of them just only code on blue chips, and then another guy just code on super illiquid thing. It's almost like, oh, if it picks up, it will pick up tremendously. Even within us, we have different niche fragment that we want to look at. I think I stay here because it was a super fun thing to do and the returns is actually pretty abnormal. When volume dies down, obviously I spend my time elsewhere. The NFT case was, there were so many edge cases that it makes it fun and highly profitable.
At the height of NFT mania, there were dozens and dozens of projects launching every single week. How did you decide what projects to get involved with and quote on and try to snipe? How did you decide what to ignore?
I mostly will rely on the Twitter response and all the hype that I can get just from sentiment analysis from the Twitter and Discord. That's about it. There was a lot of bots and there was a lot of people hired just to say good morning and this kind of thing in Discord and just to reply random bots on Twitter. We pretty much can filter that out. So whatever is left, we assume that is organic. I always base on the perceived organic demand for the collections and then decide whether or not it's worth the effort going into.
As the name implies, NFTs are non-fungible. I'm curious how the idiosyncratic features of NFTs change the way you think about market making. In a lot of these collections, there are parts of the collection that are considered rare. There are traits in the collection that are considered unique. How do you think about market making and quoting around these idiosyncratic features?
People would think that rarity plays a significant importance into the pricing of each NFT in the collection, but it's not true. The top 1% matters, and then the rest of the 99%, people don't care if you're like a 1000th rarity in the 10,000 pieces collection or you're like the 90th, something like that. Only the 1% matters, and then the rarity that the project perceives and the rarity that the market buys into is willing to pay is different thing. At the start of the thing, every collection will have things like ice, which is diamond, and then like gold, and whether it's wearing a chain or like it's something that is very replicable to any other thing. Then new collections try to come up with new things and whatnot. Eventually, you will see that whoever support the NFT, you will have these specific people that were super vocal about NFT and whatnot. And then once a new collection come out, they will change the NFT to the one that's hottest. So actually, these people are deciding which is the trendy trace, and it's not gonna be 100% with the metadata that the NFT project is trying to target. For us, the truest pricing of the trade is just by past trades. With that rarity within that range of top 1%, what kind of rarity do people bid for the most? And then what rarity do people actually willing to be price agnostic for? And they're trying to go and immediately lift the floor. So that was what market trace means in NFT, and then what we base our pricing on.
There's no real easy way, at least that I'm aware of, to hedge out broad NFT beta. How did you think about managing inventory risk?
There was like a lot of advances in this front. There would be NFT perps, there would be Wasabi that has gained some significant traction. But even then, there was just not enough liquidity to actually hash out what you want to hash for. So for example, when Pudgy Penguin hit the low of it, and we really want to buy a lot of it without moving the prices so fast, we try to do a perps onto it, but the liquidity there was 3 Pudgy Penguin or something like that. We couldn't get to the size that we want. On the other hand, there was a lot of projects that were super hype up, and we actually want to hedge against our inventory, and there were just no seller. There will be just only buyer or these purpose where there should be like at least some sort of balance or at least some liquidity. I don't have a good way to manage inventory except for trying really hard to get the homogeneous, like the non-rare NFT out at a good price as much as possible to cover the rest of the inventory that I'm willing to sit on.
Unlike trading futures or perpetuals, NFTs are a very capital inefficient trade. They're going to eat up all of your capital. How do you think about measuring the opportunity cost of capital tied up in your inventory?
I think we have a rule of thumb. We have a threshold across different collections. We would rank them like, oh, this is gonna die within 3 months or this kind of thing. And we have like an actual notional number that we put as a threshold. But other than that, before band down, there was already something else. I couldn't remember the name off the top of my head, but with the help of band down, with the help of blend, and this kind of thing, there would be easier way to like get a collateral on your NFT. On Solana, there was Shopify that was really popular for a while. And on Tencent now, you can get cross margin, which is a big help. But other than that, the opportunity costs for us were just capped at that pretty arbitrary number that we want to put a stop for different ranks of different collections that we hold. We do have like a time delta that we want to hold as well. Either that fixed notional number or the time delta, we will reduce our holdings accordingly.
Can you talk to me a little bit about the sorts of features you looked at that would actually impact your spread size? What would cause you potentially to quote tighter or wider across different collections or within the same collection over time?
For us, the most important thing would be volume. The more hype a product, that normally leads to a very condensed volume. The volume profile of NFT is actually follow the same kind of seasonality that you can observe across different collections. During the heightened volume period, be it right after mint or like a release of the metadata, some announcements, staking, some integration. During that volume, we will code pretty, not as thin as people would expect, but at least we try to stay on top of the book most of the time. And then when that volume drops, we adjust our spread accordingly. And then by that time, on the way down, we would already reduce our inventory in such a way that we can sit on it to capture the higher spread. For other things, we do have some sort of like sentiment analysis built in, but I don't think that plays as much of as importance as volume and price momentum at any point.
Eventually, over time, and you alluded to this when you talked about the evolution of the space, there were new exchanges that were launched. OpenSea, I think, had the predominant amount of volume in sort of that big NFT boom. I think it was in 2021. And then you had LooksRare and eventually Blur that launched and were trying to steal liquidity from OpenSea by offering points. And eventually those points were translated into tokens. What happened with these is both standing orders and executed trades were awarded ultimately with some sort of monetary incentive. And so I'm curious, from your perspective, how did these measures impact the math around quoted spreads? Because no longer were you making money just from the actual trade, but you were getting some sort of kickback or rebate in the form of these tokens.
It changed the landscape of participants and the volume profile. It keeps the volume profile of certain collections up for a long time, and it introduced like new players into the whole scene. But ultimately for us, it doesn't change much the way that we quote. We do have some numbers about their last fundings and whatnot, but we do not have like a realistic or reliable number to calculate how much the points would be worth. If I recall correctly, all the crypto Twitter was super hype up on Plur, and then every one of them would be like Plur millionaire by the time Plur airdrop is done. And a lot of people were disappointed. We did have some thoughts into how do we incorporate these into that, and with some speculations and then mostly disagreement from a few of us from how much this point would be evaluated, we decided against factoring these into the way that we quote. I don't think that we quote for points or volume at any point in time. We just quote for the hope of profit.
The other thing these exchanges did, and again, you mentioned this when you were laying out the change in the landscape, is they created some semblance of an order book that people could look at and evaluate at any given time. No longer was it just listed asks that you could see, but you could see standing bids, which was very different than what you could originally see in OpenSea. How did this change affect the way you were quoting?
It changed the way that we think about trades and rarity quite a bit. In the beginning of this, the trace and the rarity of your specific NFT in relation to whatever is available is listed is gonna matter. If there's only like the lower ends listed, there's no rarity thing. Because at the start, if you want to buy a rare one, most people would OTC. But on Blur, even the rare one is listed in a way because they are lended out for collateral and whatnot. Standing bits like this even make us not care about the rarity even more. But then we have a few things in place that once a rare one that we think is should be valued this much is nearer to the floor and we can pick it up, we will have a few checks to pick it up or like aggressively move to a point that we can pick it up. This is an interesting point because there's actually a few incidents of this happen and we pick up a rare one for cheap. But other than that, I don't think we changed the entire way that we're quoting. We just put a few more algorithm in place, a few strategy in place to pick up the ones that we think are selling for cheaper.
Going big picture for a moment, ultimately, where do you think your edge came from? And maybe you can talk if there's a little bit of evolution in your edge. And I'm curious about your answer on two fronts, maybe your edge versus your competitors and your edge versus ultimately your counterparties.
I think at first our edge was technology related. Fewer people who are interested in NFT are truly there for the cultural aspect and the hype aspect. And then most of them would be like retail traders, and we would not written any specific code to buy one NFT. They would be super OG and veteran, and they have the funds. It wasn't cheap; it was super expensive. And then you need OGs to make sure that they pay gas to win the transaction and whatnot. Our initial edge would be technology. Our counterparties started out as people who just want to own NFT for the non-financial aspect of it. Then eventually when this become like a hype, there would be people, there would be flipper who came into the scene and then they just flip for a small profit. And these would be the counterparties that we will wait on the order book patiently for. They would want to move on to the next hot thing. Eventually, when Plur and especially on the points system came, players in the scene became a lot more sophisticated. There wasn't much minting anymore, so our technology edge there is pretty much non-existent. You will see different people trying to implement different things on Plur. And then when Plur started, not everyone would have API. Only when you trade to a certain extent, like your volume justify, then you will have API. Same go for Magic Eden, same go for Tensor. It became a little bit technology when the order book thing and the whole bidding thing became a thing. But eventually it became like, oh, okay, who can better predict the relative price of this NFT in relations to, I don't know, like the chain that they are on, whether or not the next project is going to steal liquidity from whoever is going to get out of this now trend project first before moving on to the next one. So it became a lot more on that. I think our edge is just from the fact that we trade a lot of momentum stuff. We do have a few things to look out for regarding to momentum. I think that's pretty much where we are right now.
With regards to momentum, some of these projects can catch fire and move very quickly. Some of these projects can die very quickly. How do you try to avoid that risk of getting caught with inventory in a dead project?
So what we did was we made sure that we try our best to gauge the organic demand, and then whatever volume that we can monitor from actual trade plus the order book, sending bid and offer, that's pretty much determines how much inventory we want to keep and how desperate we want to get out of our inventory. Because thanks to Plur and Tensor and to a certain extent Magic Eden, there would be a lot of people playing standing bids. So if you want to get out of the collection, it wasn't so much like OpenSea whereby you just pray. Now you can pretty much sell super fast into the bid and you would be able to calculate exactly how much you would have once you get there. So that is that. We was caught in a lot of projects that was just the community just didn't like them anymore. Somehow overnight, the founders failed to launch like 3 different NFT projects at the same time, and the community didn't want that and this kind of thing. We were caught in this scenario quite a number of times, and each time it was pretty much a new story. We just tried to enhance our algorithm a little bit better after each time it happens.
Another one of the risks that I see that could pop up from time to time, especially in the blue chip collections as of late, is these NFTs will do a big airdrop. So we saw it with Bored Apes and Ape Token. We saw it recently with Pudgy Penguins and Pengu Token. I think Azuki just did it with Anime Token. And effectively, you don't know what the value of the token is going to be, but the NFT tends to get a lot of momentum and then, like an equity, goes ex-dividend after the value is extracted. How do you think about managing this risk where the momentum's very positive, you don't know what the token ultimately is going to be worth, and the second the token is going to launch, it's going to fluctuate dramatically, but you do know the NFT is suddenly going to, once that value is extracted, drop often 30, 40, 50%. How do you think about quoting around that and managing that risk?
I think we have a pretty good example of Bored Ape back then. So when Pudgy Penguin did the same thing, it was a lot easier to predict what's going to happen. And the exact same thing that happened with Bored Ape happened again with Pudgy Penguin, which is people was buying them like crazy and expecting like a certain amount of airdrop. Obviously, Pudgy Penguin didn't announce exactly what would happen. I think NFTs and pretty much crypto, you may not have the information, but you can deduce from the market trades what's going to happen. So when you see so much market trades happening like abnormally, and then people don't have the patience to wait for the orders to be lifted or picked up anymore, then you would expect people to already have some sort of information that you don't know, and then you assume that they're going to be right. That was what we did. Lucky for us, for NFT and for anything on chain, you would have information that a normal orderbook you wouldn't have, which is who is buying the thing. With this information, you know, like, oh, this person suddenly want to have this much exposure into Pudgy Penguin. Let's check his history, and then let's check, oh, who's this wallet and what's the expected ROI of his previous thing. Because of that, we would play with that kind of mentality that the same thing would happen to Pudgy Penguin as they happen to Bored Ape. After that ex-dividend thing that you just said, even if you sell it at a price that was lower than the price that you acquire, you will still make money. That happened quite a lot. And then you will see a lot of things like, oh, there would be Pudgy Penguins who bought them a while back and then who didn't even know that they haven't claimed the Pudgy Penguin that was listed. You can buy those Pudgy Penguin and then claim the airdrop and then sell it back to the standing bid. So I think a lot of people did that. I think now it's just stabilized, and then anime was not that hype, but the same thing did happen again.
So despite being the vast majority of our conversation so far, you actually don't spend the majority of your time on NFTs today. Obviously, we just went through another NFT hype cycle, but they died down for many years. And you've spent a lot of time focusing more on traditional market making, centralized versus decentralized exchange arb, cash and carry trades. I'd love to get your perspective on how you think this market has changed post FTX.
I think FTX changed the scene pretty tremendously. Low volume was there in 2017 when I first got into crypto, but post FTX, you will see just dying open interest and then dying volume across the board. There wasn't a lot of attention to anything. But I think we survived pretty much the worst of that. Thanks to NFT, one of the things that I did spend a lot of time on is actually Solana. It has like a lot of incidents back then. It's the most hated chain among all the OGs and whatnot. But luck, and it's like the most hated chain after FTX because it's already labeled as an FTX chain. If it wasn't for NFT, I wouldn't pay so much attention to Solana and whatnot. I think the majority of crypto tourists and a lot of people who couldn't raise and raise in crypto, and a lot of people who just want to be in it for the fast money and the high valuation token and whatnot. Not all of them would have left, but we have seen the worst of it. And then a lot of interesting things are happening. We see a lot of tools and platforms that help us reduce market inefficiency and also capital inefficiency. We see new ways collateral is being managed and how people actually move their trading on chain. Your favorite would be Hyperliquid, and we do trade a lot on them. It was really bad when FTX happened, with people scrambling to get rid of their FTX credit. And now with the whole new political scheme into place, we still don't know what's going to happen, but at least a few things have been signed and things are looking up. So I'm very hopeful about the future, and I'm glad that I stay here.
In our pre-call, you mentioned that there's an offhanded remark that gets said a lot, this idea that assume Binance is fair and quote around that when people are market making in crypto. You said that you don't think it necessarily holds anymore, and that in many cases, the lead lag relationship between centralized exchanges and decentralized exchanges has actually flipped. Can you expand on that for me?
When I first came into the scene, Binance was the definite lead of pretty much all assets that it has to offer. And then when I quote on a less liquid thing, for random venues, I just quote around Binance and then get fuel on the venues and then hash on Binance. Now it's not technically true anymore. You will see a lot of price discovery actually happening on chain. And then at first, when people didn't believe it, people try to quote around Binance, and eventual price come onto the on-chain prices, they would be caught by surprise. We did get caught by surprise. We saw this happen, and then we look a lot into it, and we see it happen for quite a number of assets. On-chain first price lag relationship has completely flipped for this specific set of things. And then there would be things like whenever people try to sell in larger quantity, people traditionally would try to send the token onto centralized exchanges first and then get rid of the tokens there. Now you will see on-chain orders of a few millions at once. Just for the last Trump token event, you will see a standing order like a DCA order that is 5 million worth into Sol and like at least 2-3 million worth into the Trump token. So a lot of these, although at that time Trump was already listed on Binance, Bybit, and liquidity was super strong there on both the spot and the pubs, but people still want to buy on chain. And if you watch Trump prices, it's actually on chain prices leads Binance and Bybit prices by quite a lot. The tables have flipped on that front. Stack's app is no longer unilateral in the way that the move happened. Now you have to actually look at a lot of things and then try to determine whether or not the assumption that you have will hold true. Market on chain has matured to the extent that you would not have easy inefficiency to cash anymore. Last time when things like, oh, there's a standing limit order for this particular asset at this specific price, people would come and think like, why would you want to publish your intention so broadly and everyone can check it out? And then you can get front run and 2,000 things can happen in a predatory way. Eventually you will see that no, they actually want that. It's not an accident that they did that. They actually want to publish their intent. This makes trading on chain, which is our focus, a lot more fun and challenging now. Because I came from MEV times and whatnot, so you only need to make sure you don't do anything stupid. You're gonna survive. Now it's a lot more on, let's be serious about this. Let's not assume that the other party is making a mistake and whatnot. It's a lot more fun.
I'd love to stick with that point for a second and have you expand on how do decentralized exchange-based opportunities differ from centralized exchange-based opportunities?
For us, there would be a lot of more volatile asset is to wait once it's get to SEC listing. It's actually really fun. So last cycle, at least when you get a SEC listing, it's gonna be the biggest milestone that you're gonna have for a while, and price will shoot up just because you're now KYC, you're now acknowledged as one of the big boys and whatnot. For a lot of our cycle, the centralized exchange listing is actually the start of downtrend only of momentum for the token. We're just in a time whereby there will be a lot of meme and there will be a lot of actual projects that will have trading on chain way before it get onto a centralized exchange. How people perceive a centralized exchange listing is dramatically different now. The edge that we would have on DEXs would be a lot on data. On centralized exchange, yes, you have to look at your order book, you have to look at the microstructure, you have to look at, okay, what are the 2000 different features that you're trying to linear request on. DEXs, it's not so much about that, but there's like a completely new set of data that you look at. You would be looking at, okay, who are counterparties? Does this token seems organic? Is this even real? Are you trading against one party that pretend to be 2000 people, or are you actually trading against 2000 people? Because that's going to change like how you code things and whatnot. So your edge in these two things are different compared to last cycle. Last cycle, you only need to know like the same token universe, how it behave on Uni V2, how it behave on Uni V3, what's the range of liquidity on this one. Accordingly, if you try to make that into an order book, what's your centralized order book look like? Now it's very different.
Do you think that the transparency created by moving on chain is financially detrimental to traders? You mentioned DCAs as one example. Those can be implemented algorithmically through smart contracts now or through Uni V3 ranges. Those sort of things become incredibly transparent and easier to pick off. Ultimately, is this move at the cost to traders, or do you think there are benefits to this transparency?
I used to think that it is detrimental to the traders because you can definitely get front run with Jupiter DCA and with Hyperliquid DCA. I don't think so. I'm not sure if that holds true across the board anymore. You will see a lot of Jupiter DCA is actually very predatory. Like they actually want people to follow them into the momentum. And then if they don't have good enough tracking and good enough monitoring, they would buy into something that original DCA signer has no intention to hold. So that's introduced like a whole change of landscape. For Hyperliquid DCA, I think, yes, you can front run, but not in the same way that a normal front run would be. Like people would set a DCA for hours and then you front run them, meaning you want to assume the risk that they will carry to the end, the DCA order and whatnot. I would think that on-chain people who use this kind of order are not just lazy retail traders anymore. They do it with full intention and they do want to publish that they are doing this. So whatever the true motivation or like whether they stick to the same original intents that they publish is another thing. So not that much detrimental. It's just a tool for any other trader now.
As liquidity continues to get more fragmented across centralized exchanges and different decentralized exchanges, how important is it to incorporate these on-chain metrics to get an actual understanding of what the true standing order book looks like?
I actually talked to a few friends of mine that are quoting in the scene still at bigger shops, at independent shops like ours. I sit at the intersection of like both centralized exchange and decentralized exchange because although we don't quote as much on centralized exchanges as we used to, we still quoting. We're just moving a lot on chain. We still quoting quite a bit on centralized venue. When I talk to my friends who are quoting on centralized venue only, they don't seem to be bothered by the fact that they need the decentralized venues information to help them with better pricing. Originally, they already ping for quotes on chain. So that's about it. They are happy with that and they remain happy with that. doesn't seem to change much that now that they can construct their whole order book to supplement the centralized order book off-chain, they do not seem to be bothered by that much. I don't think you need the decentralized venue information that much. On the other hand, I think for people who quote purely on the centralized exchange, most people do it for rebates and different credit airdrops, volume across different wallets and this kind of thing. I don't think the profit profile for them has changed as well, as much information as I can get. Eventually, the conversions will be in some sort of manner, but I don't think we are near that point yet. People are still talking about Hyperliquid as a lone thing rather than, okay, there would be some comparison about Hyperliquid and Binance, but Hyperliquid and Binance in the same book, the way that we build internal central limit order book, I don't think it has reached that point yet.
With multiple decentralized exchanges existing across a number of chains, how do you think about maximizing your return on capital? Making sure your capital doesn't get stuck on some exchange where there really is far less opportunity at any given point?
I don't really have a very good answer for this. Get started on Hyperliquid. It was just that coating on Hyperliquid is gas free. That pretty much like nothing much but integration to get us started. And then when we first coded there wasn't much volume either. It wasn't one of the first things that we look at. It wasn't as hype as a few other decentralized venue at that point. After the Frentech index, volume just 100x. And then you will see the volume retain, and then you will see the volume is actually non-toxic. We stay there just because we can make market, given the limited universe that they have, pretty well. So we stay there and then we continue to grow when volume came, and then even more and more retail flow came in. I think we were just lucky because when we started, we would have no idea. Integration was easy. We can definitely see that Jeff is someone who traded before. The API integration was a lot less resistant than other venues, but we couldn't predict that this is going to be huge. On the other hand, there was a lot of venue that was super hyped up. There would be retails and there would be people, this airdrop famous guy on crypto Twitter who keep pumping the same thread that, okay, let's go trade here. We're going to earn a lot of airdrops and whatnot. We are never in it for the airdrops. So that's one, but this would be very indicative of like the flow that you're going to get. We integrate and then surely we get flow when it's still the hype, and then volume just dies down. Nobody cares about it after a while. It's not the venue's fault or anything. I don't think that's the case. It's just that it's very difficult to acquire user in this super competitive market. So when volume dies down, there wasn't much for us to do. We eventually scale down and move on to some other thing. That's pretty much our strategy. I don't try to predict so much that this is going to be huge, because we used to believe that, oh, okay, this is led by this VC, that VC, they have a lot of funding. They had a lot of money for user acquisition. They will eventually be huge. We used to think that way, and then we integrate to a few, and then there was a lot of venue that the volume was just between us and pretty much two other people who are there. So we can straight away see if it's toxic or not, people want to trade or not, or like the same watching mechanism is there, or like your open interest remain the ridiculous number and then the TVL doesn't grow, things like this. So I don't have edge in this, so I just pick any one that looks good and then be there code for a while and then eventually decide whether or not to scale up or scale down and then move on.
In our pre-call, you said that, quote, alpha from 2 years ago on very fundamental things just doesn't work anymore. I was hoping you might be able to share some examples of what those alphas were, but also I'd love your perspective of, is this because market participants have changed or just a classic case of markets becoming more efficient over time?
I think one clear example that we can touch on is that last season, people want to buy the governance token, but people don't actually care about governance. So when there will be a new governance proposal that we scrape, For example, recently there would be the proposal from Witmute to be market maker for CalSwap. So we thought it's like, oh, okay, this is good news. And then the price should at least indicate that, oh, okay, things gonna pick up for CalSwap and whatnot. We get into the position. For this kind of news, last season it would be that nobody reached the governance. But then eventually when people buy, like builds into the position and you can see people builds into the position, there would be threads on Twitter that say, oh, did you see this? And then that makes the whole market jump onto the trade after somebody already builds position. So when we build our position in the same way that we did last cycle, pretty much nothing changed. And we don't see any other participant except for Wintermute that builds the position. And then we were like, okay, when's the trade is gonna materialize? It did to a certain extent when eventually 2 months later, like even that they finally mentioned that the governance has passed, price did go up a little bit. This last year, prices has been super volatile. So by the time we scale into the position, we have to get out when prices didn't hit the price that we want. And then even when prices go back up, because we still continue to monitor, it doesn't seem to be of the scale of the profit margin that we would expect from last season. So this fundamental value alpha, or at least how you predict the market would react for this particular thing, is no longer working. And especially for things like, oh, there's going to be a massive unlock that was already published, but people don't care about. This massive unlock used to mean that it's going to be massive selling pressure and whatnot. We don't see that play into much importance now, as we know for a fact that people will already hash the unlock beforehand, and people already OTC the unlock pad beforehand. There would be a lot of deals that buy the lock token at a discount, and then when it's unlocked, they will just sell it at a more crucial time frame. So this immediate price impact this would be super profitable is not that huge anymore. So this kind of thing has changed. The later we would know specifically, because market has become more complicated. There would be more sophisticated player who offer to OTC and who already know how to hedge. Last time there was just VC with DAO or trading arms that you have to care about, and then for them it doesn't make sense, and it would be quite inefficient for them to go and ask for quotation around and then try to open a pubs position, manage collateral, manage margin, and all of that. Now there would be already sophisticated players in acting as middlemen to carry this risk for them. So now you don't see that much impact on these events anymore. The later is definitely because of sophisticated player. The previous example, I don't know, we're still trying to figure out.
Well, Thao, we've come to the last question of the podcast, and it's the same question I'm asking everyone this season, which is, what is something you are incredibly passionate about today? It can be completely outside of work. It could be a skill you're learning or something you're doing or book you're reading or music you're listening to. Just what is something that's really caught your attention that you're passionate about?
I'm just super excited about us being in the market. Last year was the first year that I started a shop on my own. I completely underestimate the effort of non-trading aspect of a shop. I run a few pod before, so when I think, okay, maybe it's time to go fully prop and then run a shop, I am completely ignorant of the fact how blessed I am to be shielded away from all the random non-trading stuff that I absolutely hate. So a lot of time the year before last, but yeah, the whole mess has become 1 year. So a lot of time was sucked away doing things that wasn't pleasant or beneficial to trading at all. Plus this year, we have settled a lot of the infra that at the standard that I'm happy about. So we can explore really fun stuff. We made decent returns last year. So we're comfortable position to do fun stuff this year. So yeah, I'm happy with the team. I'm happy with like the current legislations and the current political scheme, regardless of how Trump is as a person and whatnot. I'm happy things as is, and then I'm excited for what we can achieve this year.
Thao, thank you so much for joining me. This has been very fun and very enlightening.
Thank you so much, Corey. I'm really happy to be part of the show.